Welcome, market participants, to another Three Things in Credit. I'm Van Hester, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So, earnings season is underway, and expectations are double the prior record outside of recoveries from recessions. Let that sink in. Strong productivity gains and modest wage gains form a highly constructive underpinning to earnings growth. Now mix in the ripple effects from the ongoing powerful wave of tech capex and an oil spike, and you have the makings of, well, another extraordinary earnings quarter. Let's enjoy it while it lasts. This week, our three things are: 1. Jobs weakness. The June report confirms all is not well. 2. Q2 earnings. We're set up for a strong quarter. 3. Robust consumer spend. So says one well-informed observer. All right, let's dig a bit deeper. Jobs weakness. I think Kevin Warsh is right in setting up a task force to look at how we look at the labor market. It's amazing to me the degree to which there are opposing views of the health of the jobs picture. Look no further than FOMC thought leader Chris Waller, who, in the space of a couple of months, called the labor market on one hand weak and fragile, while on the other stabilizing with unemployment fairly low and stable. And that's before the June jobs report. Now, speaking of that report, markets shrugged it off as okay. But when you peel that onion, it's hard to make the case that all is well. Yes, the unemployment rate came down a tick to a low 4.2%, but that's largely attributable to the labor participation rate falling to its lowest level, 61.5%, in 5 years. While the number of unemployed fell by 213,000 in the month, the number of employed workers fell by 507,000. If June's participation rate held at May's level, the unemployment rate would have risen to 4.6%. All right, let's talk about job creation. We have long made the case that the U.S. does not have enough workers, or enough workers with the requisite skills desired, to fully drive economic growth. In June, 57,000 jobs were added, about half what the consensus was expecting, but enough nonetheless to keep the unemployment rate low, helped in no small measure by the aforementioned falling participation rate. Now, while this outcome in and of itself would help keep the FOMC's focus on the price stability part of its dual mandate, we would remind that this depends on your view of what maximum employment means. Maximum employment of the available labor force is quite different than maximizing employment. But we digress. Back to job creation. The June edition comes on the back of what most believe has been an inflection point, where the prior 3 months saw jobs growth pick up substantially, averaging 164,000 a month in the best 3-month stretch since the first quarter of 2024. But let's dig into this a bit. In the latest report, we got sizable negative revisions, 74,000 to the previous 2 months, taking the 3-month moving average down from 136,000 to 111,000. Still better than 2025, but not quite as robust. Now factor in survey data, for what it's worth, from the Conference Board, ISM, and NFIB, all have been softening on the jobs front. Then there is the quality of the jobs created. Lower paying healthcare and private education positions came in at 69,000 in the latest month, accounting for all and then some of the 57,000 new jobs, continuing a trend that has been in place now for some time. Over the past year, job creation outside of these two sectors has been negative. One quirk in the data, a 61,000 plunge in leisure and hospitality on the back of a run-up of 40,000 in May. Distortions due to World Cup-related hiring are surely at work, but the drop in June seems to suggest something more, quite possibly weakening consumer demand, although that's debatable, as we'll discuss in a moment. In any event, the drop in leisure and hospitality is probably not a plus from a growth standpoint. Mr. Waller may want to curb his newfound enthusiasm. All right, on to our second thing, Q2 earnings. So on the heels of what Deutsche Bank called the strongest earnings quarter performance in 20 years, expectations for Q2 are buoyant to say the least. Improving macroeconomic visibility over the course of the quarter became a meaningful tailwind to earnings, as has the ongoing tech capex supercycle. Excess profits among energy firms is also contributing to the strong overall outlook. Consensus year-over-year growth for Q2 is a robust 23%, according to FactSet, on revenue growth of 12%. And that follows Q1's 29% earnings growth on 12% revenue growth. For the full year, the bottoms-up consensus estimate calls for earnings growth of 24%. And while the Mag 7 is expected to grow earnings by 38%, the rest of the S&P 500 is no slouch, coming in at a more than respectable 19%. Guidance has been unusually strong this quarter, with 63 company managements guiding higher, well above the long-term average of 41. Firms guiding lower, number 48, below its long-term average of 59. The bottoms-up EPS estimate for the quarter actually rose 3.4% during Q2, bucking a long-term trend where estimates typically decline on average by 4.2%. 10 of the 11 S&P 500 sectors, all but healthcare, are expected to report earnings gains in Q2. Leading the way, no surprise, is energy, expecting earnings to more than double on the back of the recent oil spike. But energy represents about 4% of the index. Infotech, however, continues to do the heavy lifting here, with earnings expected to grow 63%. And that's good enough to account for about half of the index's total earnings growth. And within tech, it's the semiconductor names driving the vast majority of that earnings growth. Away from tech, materials up 35% and utilities up 14% round out the double-digit growers driven by infrastructure spend and investment in power, respectively. Now, for the full year, FactSet's consensus is calling for earnings growth of 24%, up from 17% at March 31st. All 11 S&P 500 sectors are showing earnings growth. Needless to say, this is all supportive of credit. All right, on to our third thing, robust consumer spend. I have to admit this report caught us by surprise. Bank of America's latest monthly consumer checkpoint, which comes out of its institute and tracks consumer trends based on the bank's internal cards data, characterized consumer spending as, quote, remarkably robust, unquote. Total credit and debit card spending per household rose 5.1% year over year, the largest gain in nearly 4 years. Yes, higher gas prices contributed about 1.2 percentage points to the increase, but these are still strong results. The report, with data through May, adds that the bank sees, quote, little sign of shift in consumer behavior that would suggest weakness, and that consumer financial health remains strong with no clear signs of households resorting to borrowing to support spending, unquote. In other words, it's literally all good. Now remember that the spring brought with it elevated tax refunds, and we had a rip-roaring stock rise in May. And let's not forget that B of A typically, but not exclusively, banks the upper prong of the K-shaped economy. But still. Now, across the economy, that bottom prong on the K, called the bottom 60% of household earners, still accounts for a not insignificant 39% of total consumer spending. Now, is it all good? Well, we would counter with the fact that severe delinquencies in credit cards are at or near all-time highs, and the savings rate has fallen well below long-term averages. And according to other data, not insignificant cohorts of Americans are struggling financially. In its recently released annual report, Economic Well-Being of U.S. Households, the Fed reports that 16% of adults in 2025 did not pay all of their bills in the prior month. Some 30% rarely or never have any money left over at the end of the month, including 15% of those earning more than $100,000 a year. 28% of adults say they are worse off financially than a year earlier. In contrast, B of A noted in the report that lower income and middle income households grew spending at a quite healthy rate of 4.1% and 4.3% respectively year over year. Discretionary spending for both lower and middle income cohorts was, in the report's eyes, robust. Just 1% of the households B of A banks may have stopped buying discretionary items like clothing and restaurants. Moreover, B of A said there was, quote, little sign that higher gas prices have dented momentum yet, unquote. Well, just this week, PepsiCo described weaker demand in its Q2, observing the consumer is worse than what we had anticipated, and it's driven mainly by gas prices. A bit of point-counterpoint. In the aggregate, we know consumer spending has held up well. Much of that is attributable to the historic wealth effect that the ownership class, that upper prong on the K, has enjoyed. But don't lose sight of the headwinds that the lower prong is facing, because that will lean on overall economic growth in the second half, in our opinion. So there you have it. 3 things in credit. 1, jobs weakness. Pay attention to the labor participation rate. 2, Q2 earnings. Another blockbuster is on the way. And 3, robust consumer spend. Look for consumption to slow in the second half. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.